Annuities are a topic on the outline for this exam. They are a life insurance product. They are not, however, an emphasis on your exam. I will do a full annuities discussion, but if this is an area that gives you a hard time, remember, I expect you would have 0, 1, or 2 at the very most questions on your entire exam about annuity products. So life insurance is protection. You buy life insurance in case you may die tomorrow. There'll be a face amount paid out, a death benefit paid out to your beneficiary. An annuity is the opposite of life insurance. Annuities are designed to pay you, the annuitant, a dollar amount monthly for life. I can still vividly remember when I was a kid, the first time I heard my dad explain what an annuity was and how it worked. I thought, sign me up. This idea that once I start taking payments, I get paid monthly for life, no matter how long I live. And I told you earlier that I'm going to live a really long time. How do I know? My grandpa, when he passed away, he was 98. My other grandpa was 97. My great aunt is 97. My great grandma was 103. Both sides of my family live a long time. So statistically, it's possible. So I love the idea that an insurance company is promising to pay me a dollar amount monthly, no matter how long I live for. So the whole point of an annuity is that it is there, some money coming to you, in case you live too long. My husband always says, I don't get it, Susie. I don't know why. Why can't I just put my money in the bank? And I told him, go ahead. He's probably not going to live as long as I am. So for me, I'd be concerned that I was going to outlive my money. Maybe he won't. But that's really what this whole idea of an annuity is designed for, in case you live too long, so that you never can outlive your money. So that's the basic gist of it. That in and of itself is probably enough to get you through the exam questions. But I will explain all the details about how annuities work. It's really going to be more of an emphasis if and when you take your Series 6 exam. With an insurance license, you can sell what's called a fixed annuity, and you'd have to have your Series 6 or 7 to sell a variable product. So with your insurance license, you can sell a fixed annuity. So I'll show you how these products work. To buy life insurance, did you have to pass a physical, go through underwriting? Yes, of course. To buy an annuity, the insurance company doesn't care. They don't make you pass a physical. They'll take your money. It doesn't matter your health, doesn't matter your gender or your age. Insurance companies have no underwriting for the purchase of an annuity product. So how does this work? I'm age 30 and I begin to pay in to my annuity product. You can pay in the premiums in basically any way you want. You could pay in a level premium, maybe $100 a month. You can pay in a flexible premium. You can pay in a single premium. You can pay in more or less than you thought you were going to. Because there is no risk for the insurance company, they'll take your money however you want to do it. So let's say I'm putting in $100 a month. I'm age 30 and I begin what's called the pay-in period, the accumulation period. So what am I accumulating depends upon whether or not this is a fixed annuity, which I told you you can sell with just your insurance license, or a variable annuity. So if it's a fixed annuity, the money that I pay in goes into the insurance company's general account, and they promise to pay me a minimum guaranteed interest rate. So in the general account, there's always a minimum guaranteed interest rate. But if you think about this, if you think about your money going in and being your promise that it's going to earn 4%, over time, what happens to the things we buy? Are they more or less expensive over time? They're more expensive over time because of inflation. So if you have a fixed annuity, it's possible, depending upon inflation, that even though you have more money, that it's not keeping up with your purchasing powers not keeping up because of this inflationary risk, which is one of the main reasons why variable annuities were invented. They're a hedge against inflation. They take the money that you pay in and they put it into the separate account. The separate account acts like a mutual fund and invests in the stock market. There's no guaranteed interest rate. But historically, the stock market has at least kept pace with inflation. So we sometimes call a variable annuity a hedge against inflation. So if a client's worried about their purchasing power risk in a fixed product, have them get a variable product. Not everybody is going to be comfortable with a variable annuity because when you get your monthly payments on a variable annuity, how much you get monthly is going to vary. So it's not always suitable for everybody. So you have to make sure whenever you sell a variable product that it's something that the client understands how it works, because their payments are going to be variable over their lifetime, which is going to also be variable. I'll explain, don't worry. So fixed product you can sell just with your insurance license. Variable, you need to be registered with the NASD. You need to have your Series 6 or your Series 7, as well as your life insurance license. If it is a variable product, we have during pay-in what are called accumulation units. So sometimes that's a test question. You have accumulation units during pay-in on this variable product. During pay-in, very flexible. You can put in as much as you want. You're paying in what we call after-tax dollars. This is a non-qualified product. So a non-qualified annuity means that it is funded with after-tax dollars. So that the money that you put in represents your cost basis. The money you put into an annuity product is in after-tax dollars. You don't ever have to annuitize. To annuitize is to start the monthly payments. You don't ever have to do that. If you have this annuity product, the feature that's the best feature for all annuities, even though I love the fact that you can't outlive the payments, that's not the best feature. The best feature is that the annuity during the pay-in, the earnings are tax deferred. These earnings, whether or not they're the 4% or they're the rate of return in the separate account, the earnings are not taxable currently. The earnings are tax deferred. That is the best characteristic about an annuity product, that you have earnings and you don't have to pay taxes on them right now. So you have money in here and you have not annuitized because you don't ever have to annuitize. And you are, let's say, age 55. If you die during the pay-in period, there is always a beneficiary. There is always a beneficiary. They're going to get the value of your account. So it's not protection. The insurance company doesn't have any risk. If you die before you annuitize, if you die during the pay-in period, your beneficiary is going to get whatever you have in your account. So if I put in $1,000, they get $1,000. If there's $100,000 in there, then that's what they get. But the insurance company doesn't have any risk at all. They simply promise to pay to my beneficiary whatever the value of my account is. So I could pay in $100 and buy an annual renewable term policy, and if I die this year, my beneficiary gets $100,000. That's protection, that's life insurance. Or I could put $100 into this annuity, and if I die this year, my beneficiary gets $100. So it's not protection. But I do have a beneficiary for whatever is in my account during this pay-in period. I can choose to annuitize, or I can choose to never annuitize, and if I don't ever annuitize, then the value of my account simply goes to my beneficiary. Let's say I paid in a single premium. Let's say I put in $50,000, so after-tax dollars, and I'm in pay-in, I've not annuitized, and I'm age 55, and the value in my account is $80,000. Let's just say, what's my cost basis? Cost basis is after-tax dollars that I put into this account. How much after-tax dollars did I put in? That's this premium here, so $50,000. I decide to take, at age 55, a partial withdrawal. The test wants you to know that when you take a partial withdrawal on an annuity product, the IRS always wins. They're going to tax this LIFO, which is last in, first out. Which another way of saying that is that the earnings come out first. So if I decide to take a partial withdrawal of $10,000 in this product, I decide I want $10,000 out at age 55. They're going to assume that this is my earnings coming out, last in, first out. Because really, if I paid in 50, now it's worth 80, I've got $30,000 of earnings in there. So this is going to be taxable as ordinary income. LIFO, all of it, all $10,000, taxable as ordinary income. Plus, it's a retirement product, and if I'm under age 59 and a half, and I am because I'm 55, there's also a 10% early withdrawal penalty. So annuities are retirement products. If you take a withdrawal under age 59 and a half, not only is it LIFO, earnings come out first, 100% taxable as ordinary income, but there's also a 10% early withdrawal penalty. So that would apply to the $10,000 as well. So maybe not such a good place to go to get some money. There are certain reasons why the IRS would waive the 10% penalty, death, disability, divorce, first-time homebuyer expenses, qualified educational expenses, and so on and so forth. Not a big deal on your test, but there is certain instances where they'll waive that penalty. They will never waive the fact that it's LIFO and taxable as ordinary income. Now, what else could I do at age 55? Instead of taking a partial withdrawal, I could take a full withdrawal. So if I took out all of this money, if I took out this $80,000, so they gave me $80,000, what's my cost basis? I paid in that single premium of $50,000. How much is taxable as ordinary income? This is my earnings. So taxable as ordinary income plus a 10% early withdrawal penalty because I'm under age 59 and a half. So if you take a partial or full withdrawal, you can always do that. When you're in pay-in, the annuity is very flexible during the pay-in period. If you choose to annuitize, which you can do at any age, if you annuitize under 59 and a half, there is not a penalty. If you annuitize, you lock yourself into payments. You lock yourself into getting paid a dollar amount monthly for life. So know that it's flexible during pay-in, but once you annuitize, which you can do at any age or you don't have to do, when you annuitize, there's no penalty upon early annuitization. When you annuitize, they're going to spread out your cost basis. So using this same example, at age 30, I put in $50,000. And let's say that this time I annuitized at age 60. So we start off in the pay-in period where if it's a variable product, we have accumulation units. And I annuitize at age 60. Let's say my account balance is $100,000. We begin what's called the pay out period, where the value of a variable product is measured in annuity units. They're going to look me up on the insurance company's annuity table and determine that I should die by age 80, statistically speaking. If I live past age 80, I'm still getting paid, but I'm getting someone else's money. See? Cool. Sign me up. If you outlive your money, which in this example is coming to me over the next 20 years, the insurance company promises to pay a dollar amount monthly for life, no matter how long you live. Once you live past your money, in this example at age 80, the money that you do receive is 100% taxable because none of it is your money. So you can annuitize whenever you want, Once you do, you lock yourself into these payments for life. Remind me during the pay-in period of an annuity, do you always have a beneficiary? Yes, there is always a beneficiary. How much are they going to get if you die during pay-in? The value of your account. So we know that. When you annuitize, when you start the payments monthly for life, whether or not you have a beneficiary on payout, it depends upon what annuity payout option you select. You may or you may not have a beneficiary on payout. So the test will want you to understand that you have to pick what annuity payout option you want. So I want to mention something here before I give you the different payout options. If you buy an annuity at age 30 and you don't annuitize right away in the beginning, you annuitize somewhere down the road in the future, what that's called is a deferred annuity. Deferred simply means that you're not annuitizing right away in the beginning. So most annuities are deferred. You pay in now, you annuitize someday, or maybe you never annuitize. If you put the money in today and you start your payments 1 month from now, that's what's called an immediate annuity. So if your client wants an annuity product but does not want to annuitize right away, do not sell them an immediate annuity. With an immediate annuity, they get their first monthly payment a month from the beginning, so right away, and they're automatically in payout. They're automatically, if it's a variable product, they're receiving annuity units. Once you annuitize, you're locked into this contract. So an immediate annuity is not good for someone who does not want to annuitize right away. The payments will start 1 month from when they funded it on an immediate annuity. So what are you going to choose when you have this annuity product? What choice will you make with this money? I had a student and she told me a really interesting story that I'll share with you. She said her mom had just gone through this. Her mom had funded an annuity product over the years, and here she was in retirement. And she was trying to make this decision. What do I do? Do I want to have a beneficiary during my payout period or not? And this was the decision that her mother had come to. Not that everybody's going to come to the same conclusion, but this was her mom's story. Her mom had thought long and hard about it, and the annuity product was for her. It was for her to get a dollar amount monthly for the rest of her life. This money wasn't protection. It's not life insurance. She wasn't concerned that if she was to die tomorrow that the money that's left in the account go to her daughters. Her daughter, they're all grown-ups. They're all supporting themselves. They're perfectly capable grown-ups in this world. And this product is designed for her to get money for life to live on for retirement. So she chose the riskiest payout option, which you don't hear a lot of times people choosing, but she did. She said, you know what? I don't want a beneficiary during payout. She chose what's called life income. When you take on the most risk, you get the highest monthly payment. And that to her was more important than knowing that if she didn't get all of her money back, the money would go to her daughters. No, she said, I want the most bang for my buck, if you will. So she annuitized, she chose life income. It's also called straight life or life only. Life income has no beneficiary during the payout. It is the riskiest choice. You will have the highest monthly payment. So when you annuitize, you have annuity payout options. So chosen by the annuitant. Once you choose one, you cannot change your mind. Once you annuitize, you cannot get your money out later because you changed your mind. It's just you're stuck with it forever. So life income. Riskiest choice. Highest monthly payment. You will make the most if you live and you've chosen life income. No beneficiary. Highest risk, highest payment. So if she annuitized at age 60 and she died at age 62, where would the rest of her money go? To the insurance company. And then they would use it to give to someone else when someone else outlives their money. That's basically how it works. So somebody's going to choose life income. But maybe that's too much risk for you or your client. So you can choose life income with period certain. So taking away some of the risk. So let's say at age 60, they think you're going to die by 80, so same example as before. And you choose a 5-year period certain, or you could choose a 10-year period certain or a 15-year period certain. What it means is that you have a beneficiary for the time period selected, for the period certain. So the longer you choose to have a beneficiary for, the lower your monthly payments will be because you're taking away the risk. So of these three, which one would have the highest monthly payment? 5-year, 10-year, or 15-year period certain. 5-year period certain would have the highest monthly payment. Because if you die at age 67, there's no beneficiary, the insurance company keeps the rest of your money. If you choose a 10-year period certain and you died at 67, then your beneficiary is going to get this money. Not all of it. So you're never guaranteeing all of the money with period certain. If you want to guarantee all of the money, you want to choose a refund annuity, life income with refund. So how this works is during this period of time where your money is coming back to you. So your money is coming to you by the time you're 80. If you die before you get all of your money back, then your beneficiary can choose to either get a cash refund or an installment refund. So they can just get a lump sum payment or they can get the payments made to them monthly. So if you have life income with refund, annuitized at age 60, they think you're going to live to be age 80, and you die at age, let's say, 78, do you have a beneficiary? Sure, they're going to get this money that you have not yet received. What if you died at age 88? When did your payments stop? When you die. So even if you outlive your own money with an annuity product, you're guaranteed to get paid for life. But do you have a beneficiary if you die out here? No, of course not. You can only guarantee your money. So life income with refund. A joint life annuity is your fourth choice that you could make. You have 2 or more annuitants. This is a weird choice. I don't know why you'd ever pick this, but you could. Joint life. So husband and wife annuitize. This one pays until the first party dies. Payments stop then. How sad for the widower or widower. Stop when first party dies. So not commonly chosen. So be careful that sometimes in the real world we'll use this term joint life to describe something other than what I just defined for you. Okay, so for the test, joint life, payments stop when the first party dies. The one that's most commonly chosen is joint and survivor. So husband and wife annuitize. This one pays until the last party dies. So pays until the last party dies. Joint and survivor. Much more commonly chosen over joint life, joint and survivor. A payout option that pays until the last party dies. Sometimes the payments will go down a little bit after the death of the first spouse. So if your client is annuitizing and is concerned that the payments last until whichever one of your client's husband and wife should die last, make sure that they choose the joint and survivor payout option. What are some other things about annuities that the test will want you to know? We talked a little bit about the tax consequences if you took money out during the pay-in period. When you annuitize, what they do is they take your account value and they spread it out over your life expectancy. And they take your cost basis and spread it out over your life expectancy. So in this story, I had said that you had 50, $1,000 was your premiums that you paid in, $100,000 is the value of your account. So every year, some of the money is taxable during this 20 years. Some of it is taxable, and some of it is tax-free. So if the test was going to ask anything here, which really I doubt that they will, if they're going to ask, it's going to be how would it be taxable as ordinary income. Your cost basis comes back to you tax-free, so your premiums come back to you, but it's spread out over your 20-year life expectancy in this example. And then if you outlive your money, all the money you get after age 80 here is 100% taxable as ordinary income. I don't think they're going to get into the tax consequences on the annuity product. It's probably going to be a very basic question. If you have a fixed annuity, when you annuitize, you have a payment that is fixed. You know exactly what you're going to get every month for the rest of your life. You can also have a variable annuity product where the payments are going to vary, like I had said earlier. So not everybody is suitable for that. Payments are going to fluctuate based upon the performance of the separate account. You can also purchase an equity indexed annuity. So as far as the earnings go, it works just like the equity indexed life insurance product did. It has a minimum guaranteed interest rate, but if the S&P 500 does well, you will be credited with additional earnings. You can sell the equity indexed annuity with just your life insurance license, but to sell your variable annuities, you have to have your 6 or your 7 be registered with the NASD, now called FINRA. When you annuitize a variable annuity, when you purchase really a variable annuity, the annuitant has the risk. In a fixed annuity, in an equity indexed annuity, the insurance company has the risk because both of those products have a minimum guaranteed interest rate. The variable product is regulated both by state and federal law, same as variable life insurance was. So there's kind of a lot about annuities. If you have questions, you can always reach me via our content email system. Don't stress out too much about annuities, however, little tiny bit on your test. Combination life insurance policies. So combination plans. You have a client and they want to know, should they buy 2 individual life insurance policies or should they buy joint life? So which one should they buy? It really depends upon their needs. If you have your clients with 2 individual policies, when the first party dies, it'll pay out, let's say $100,000. Second party dies, it pays out $100,000. So there's 2 different premiums being paid. With joint life, you insure 2 people and it pays when the first party dies. So if the choices were buy 2 individual policies or 1 joint life, and the question asks which is less expensive, joint life is less expensive because it only pays out once when the first party dies. Survivorship life insurance, sometimes called a last to die or second to die policy. Survivorship life, much more common than a joint life policy, survivorship life. So husband and wife are both insured. This policy pays when the last party dies. So you might be thinking, but why would you need money to be paid when the last party dies? Depending upon current tax law, when the last spouse dies is when estate taxes are due. How much is owed depends upon current tax laws. So estate taxes are due at the death of the second spouse. So the most common way to fund a projected amount of estate taxes is to sell your client survivorship life insurance. So sold to fund estate taxes. Now, interesting to note, life insurance death benefits, they go to your beneficiary tax-free. We talked about that. But they're included in the value of your taxable estate. So as an insured, you own life insurance on yourself, let's say it's $500,000. When you die, the money goes to your beneficiary tax-free, but that $500,000 is included in your taxable estate. So when the last spouse dies, everything, including the face amounts of the life insurance policies that those people owned, is included in the taxable estate. Now, who knows, when you're going to die, what current estate tax laws are going to be. But if your client is concerned about this, sell them survivorship life. And it is important to remember that the life insurance face amounts are included in the insured's taxable estate. So we talked about whole life insurance. Permanent protection covers you until age 100. We talked about term insurance, temporary, good for a period of time. We talked about its special features, renewable term, convertible term. We talked about annuities, which are really designed to be the opposite of life insurance and are designed to pay the annuitant a dollar amount monthly for life. So with an annuity, the insurance company is betting you're going to die and you're betting you're going to live. The opposite of life insurance. You buy life insurance because you're betting you're going to die. The insurance company is betting you're going to live. And then we talked about a few combination policies. That is our discussion for types of life insurance. Make sure that you read all key facts related to this section a minimum of 3 times before you go and take and pass your test. Good luck.